Formally, the next point is that instead of just focusing on your one country or one area, you can have a global investment focus. And the advantages of having a global perspective of investment, it gives you the benefits of that you can target good returns where the returns are higher. Just like emerging economies, they are generally increasing at a higher rate. In the last maybe like 10-20 years, China used to be the hub, or you can say the center, where a lot of foreign investment was flowing, and the reason was that the Chinese economy was increasing at a very high rate. Now these days, if you look to the Malaysian economy, and then even you come to the Pakistan and Indian economy, these are the economies which were emerging economies, so where the returns were relatively higher. On the other hand, it gives you the benefit of diversification, that you are not totally dependent on a single economy. So the next slide, it explains these two concepts. So if you look to the left hand side of the graph, it tells you that it is explained in terms of in US perspective, but it can be explained for any other country as well. That if you are a US investor and you are only investing in the US and you are diversifying your portfolio, that from one stock you move to multiple stocks and from one sector to multiple sector, what happens is that if you look to this downside, that as you keep on increasing the number of securities in your portfolio, what happens is that your risk keep on reducing. So this risk keep on reducing. But up to a certain level, you can reduce the risk, but after that, you cannot reduce the risk further. Within the US economy, you cannot reduce it further. But when you move to the international market, it on the other hand give you a more diversification, so you can reduce your risk level. And if you look to the right hand side of it, that if you invest the entire amount in the US or in your own country, you may have a certain level of return. So it says that your return will be like, if you invest 100% of your money in the US economy, your return will be like around 7 to 8%. If you think of it's a low risk economy, and the return will not be very high. But as you keep on moving your money from US to the emerging economies or the other economies, what happens is that as you keep on increasing it, your rate of return also increases. So when on one hand your risk is reducing, on the other hand your return is increasing. Clear? So this is the benefit of having international exposure. So but it also depends that how much money you have. With a 500,000 rupees, you may not have the ability to invest globally. So if you're a very large scale investor, and one day you will all be, inshallah, so then you can think of global investment. So global investment is good. Here comes the next important point, that is, when we talk about financial market, when we talk about market, so what is a market? So, in a simple term, market is a mechanism through which transactions take place, buying and selling of goods and services take place. So you can even take the subsidy market as well. There are buyers and sellers. So a market is only that mechanism which match the buyers and sellers, they bring them together and they help them in making the transactions. Clear? So remember that in a number of cases we required a physical location for the market, but as when we are talking about the financial market may not require a physical location, because these days you may see that there is a central stock exchange. For example, in Pakistan Stock Exchange, the building is in Karachi, but you are sitting in your home and you can still buy and sell securities. It means it is the name of that mechanism through which buyers and sellers take place. So the physical location is not a necessary condition for the market. And from the market, both the buyers and sellers benefit, because if you want to individually find a person to whom you can sell or from whom you can buy, it becomes very difficult. For example, if we need something and I have to go to the grower of potatoes and I want to buy a potato from that farmer, and on the other hand, let's say the potato farmer want to sell the potatoes, and he or she is looking for or searching for someone who need potatoes, it is difficult. But when there is a centralized market, so both buyers and sellers come there and then they both take the benefit from that market. So there are more choices, the prices are competitive. So this is also true for financial market, where we are buying and selling stocks. So we will be more focusing on the financial side of the market, not the commodity markets as such. These are very easy and simple things to understand, that what are the characteristics of a good market. So a good market is the one in which past transaction information is available. This is actually used for, let's suppose that if I want to buy or sell some stock today, I must know that what was the prices yesterday or the last week or the last month. So this past information, when it is available, it can be used for making the decision regarding the buying and selling for the future. Obviously the information should be timely and it should be accurate. So when the market is open, you can see real-time information, that how many shares are in the buy side, how many shares are on the seller side, and what is the price. So this information is, when it is available and it is available instantly, it is considered as a good characteristic of a market. The second is that a good market is the one where there is a high liquidity, meaning that where if whatever you want to sell or whatever you want to buy, you can buy and sell at a fair price, and easily and quickly, which we discussed earlier as well. This is obviously ensured by the price continuity, that the price from one transaction to the other transaction is not significantly changing. For example, if the last trading price of OGDCL stock is 320.5, you may not expect the price to be like 324 the next transaction. It will be very near to 320.5. It means maybe like 320.8 or maybe 321 or maybe like 320.1 or 319. So there is a price continuity. And then there is a depth. We call it as a depth. Mean there are more buyers and sellers available in hundreds and thousands. So it means it ensures that the market is liquid. So the liquidity risk also reduces. Another good characteristic is that the market has low transaction cost. When we buy or sell stocks, so obviously we pay commission charges on it. So if the commission charges, the broker charges, all these things are lower, it is considered as a good market. When the transaction costs are high, we call it as it's not a very good market. And this is, in finance terms, we call it as the internal efficiency, that the market has internal efficiency. And the other one is external efficiency, that whenever some new information is arrived, the prices quickly adjust to that new information. For example, if a company announces today their financial position, financial statements and all the earnings, so if the earnings are higher than the expectation, the price should increase, and it should increase and quickly adjust. And if there is some bad information, the prices will go down. So this the sign of a good market is that it quickly reacts to the arrival of new information, and this is what we call as external efficiency. So a good market is one where prices all the time represent a kind of fair prices. Now this is a questionable thing, that whether the prices are actually fair prices or not. We may think that there are manipulative trading and so many things, but what we say that if a market is a good market, there the prices should be fair all the time. It should reflect all the available information. Moving to the exchange membership. Now we are talking about stock exchange. So in stock exchange there are certain members. One type of the members, they are known as specialists. Specialists are the one who are assigned certain stocks, that if no one else is buying and selling or offering or buying the stocks in that particular company or those particular companies, you will be the one who will give a bid and ask, so that if somebody want to sell, you should become a buyer, and if somebody want to buy, you should become a seller. So you are the specialist of this particular, or these particular stocks, maybe like 10, 20 or 5 stocks are being assigned as specialists. The more common membership on the stock exchange is commission brokers. These brokerage houses that we know, they are known as commission brokers. They are buying and selling stocks for others. Now remember, these terms are historical in nature. Nowadays it is only a kind of mobile app or computer you can say program, in which you just enter the bid and ask prices and quantity, and it will be matched by the software itself. Historically, it used to be like in the stock exchange, there used to be brokerage houses. So historically, there used to be a building, and the brokerage houses used to have members where people used to buy and sell the physical shares, clear? And they used to charge a commission for it. Floor brokers used to be the independent individuals moving on the floor and matching any, for example, I'm a commission broker and I have received a buy order, but there is no sell order available with me. So I will give it to the floor broker and ask him that find a seller for this stock. And if there is a seller order available, but there is no buyer, so then I will see a buyer for it. So they used to be called as the floor brokers, but these are now being eliminated almost, because now the software itself is doing all these things. Registered traders used to be the one who used to trade for their own account. So they used to avoid the commission charges. But the role of these people used to be like that they ensure liquidity in the market. That if they purchase 500 share at a price of like 320.5, so if let's say there is a 1 rupee or let's say 50 paisa you can say commission charges on the buying and selling, it means that this stock can only become profitable for you after 321.5, because you pay a 50 paisa charges on the 320.5, so it makes it at 321. And if you want to sell, again you will pay another 50 paisa charges, so it makes it as 321.5. So you will only sell the stock if it is beyond 321.5. Only you will earn some profit, and then on that profit obviously you will say you pay some taxes. So the price continuity used to be affected, which we discussed that the characteristic of a good market is where the price continuity remains there. So these registered traders, since they don't pay the commission charges, so our stock purchase at 320.5, and if it is the person can sell it at 320.8, a 30 paisa being earned on 500, so it means it will earn you 150 rupees, and this is profit. Obviously you will pay some taxes on it, but for them, since they don't pay the commission charges, so for them it used to be beneficial. The benefit they used to give the market is the price continuity and the liquidity. So this is the stock exchange memberships.